G'day, I'm Nick Clements from YourQS and welcome to our podcast, Beyond the Guesstimate. I joined the construction sector in 1993 and pretty much ever since then I've been frustrated about how the industry works and I think there's lots of opportunities to improve it. Both my parents were teachers and I think that might have instilled my love of learning, but unlike my dad who learnt ancient Greek and Latin, I like learning stuff that's relevant to today. So I worked for Colab. So when I joined the construction sector, I was marketing manager at Carter's and then moved through the organisation, ended up working at Wood Products. Colab back in those days was one of the biggest companies in the country, had like 10,000 odd staff. And one of the big advantages of working in a corporate, I can't say I'm really a corporate guy. I don't know how I survived so long. They say about you getting promoted to your level of incompetence. So I got promoted to mine and then got shown the door, but we won't talk about that. So one of the things corporates are really good at is they do provide a lot of learning resources, and I'd actually made it into, I think they called it the top 200 managers. So we got invited to this big strategy day where they were going to have this overseas speaker coming in and talking about strategy. And it was themed around Edward de Bono's 6 hats of thinking. So critical thinking, lateral thinking. And I remember I was all trooping across into the room and we all sit down and this old guy walks out and sits down next to an overhead projector. And this was like the early 2000s. So even then, overhead projectors were really old school. We'd been using PowerPoint and data show for ages. So this guy sits down and just starts talking and drawing, writing things out on this overhead projector. And as he was going through it, he was writing it out and talking about de Bono's 6 hats of thinking. So the whole idea behind his lateral thinking is that if you put on different hats, you can think about a problem from different directions and think about it in different ways. And so he was going through how all of this worked. And then it clicked. It was actually Edward de Bono. I was sitting there listening to Edward de Bono. And it was before the internet and stuff, so I couldn't sit there on my phone and Google it. I had to go away and find out afterwards who it actually was. So that was a really cool experience. But I wouldn't say it was life-changing for me, but it made me realise that I do think about things differently to a lot of people. And I think about a lot of the processes in the industry differently to other people. And I've sort of realised through that presentation made me realise that it's actually okay. And it's actually a good thing that different people think about things differently. So today we've got Dan Bell from Colab Mortgages. So Dan's a co-founder and a financial advisor with Colab. And why all of that little story was relevant is they're looking to come into the construction sector and specialising on construction financing, but looking at it from a collaborative point of view and looking at how they can fund or put together funding deals for different projects for the unique sort of characteristics of each of those projects. So they're thinking about things differently. I want to bring people onto this podcast that think about things differently, and we'll just have a conversation about our views of the world. So welcome, Dan. Thanks for coming along and spending some time with us.
Thanks for having me, Nick.
So just Colab's really fresh. I can still smell the ink on the printing. So just tell us a little bit about sort of what you guys, and actually, so how I got to know Dan is his business partner, Sam, is my cousin's cousin, and we were at a family event a few weeks ago and just got chatting and realised that we're both sort of in a similar area, a similar field, and potential for collaboration between us. So that sort of got us talking. And then as I found out more about their business, I thought, oh, great, we'll get them onto the podcast and have a bit of a chat.
Yeah, no, brilliant. It's look, my journey into the world of finance, I guess I've been in banking and finance my whole life, and I've worked for big corporates. I've worked for big banks and other big lending businesses and mortgage brokers. And a few months ago, I caught up with your cousin's cousin, Sam Ludbrook, who was my business partner, and we were sitting there having lunch and going, you know what? We weren't quite kind of connecting with our employers at the time. We were thinking, we've been in the industry a long time. We're both passionate about particularly construction and development finance. We've both got really relevant experience and we've both been in property ourselves. Why not have a crack? So, we got our heads together and created Colab Mortgages, and we're literally in the process of launching the business to the world and making it a reality.
Good. So what sort of services are you looking to offer with the business, and what so obviously your specialisation is going to be that construction finance area. So yeah, just give us a bit of an idea of sort of how that works and what role you guys will be playing in that.
Yeah, look, so Colab Mortgages is a full service mortgage brokerage, but we have a specialised interest and passion for construction and development finance. So I guess if you look at that particular area of the market, it's quite different to a standard residential loan. So construction, development finance, is really quite a unique and specialist lending skill, and also the kind of the types of lenders that you work with, the types of borrowers, understanding the construction process, understanding different stakeholders in the industry. It's quite a different structure. So we can do a traditional mortgage, but we're going to focus on that sector, and that's certainly where our passion is. Between Sam and I, we've both got 20 years of experience, and we've also both been quite active in the property industry and market. So I've done my own residential developments. Sam's done his own developments. He's also done some subdivisions, and so I guess you could call us a couple of property nerds that that really have a passion for the sector and can see the challenges, particularly for builders and smaller developers that are looking at their funding options. And it's a pretty kind of unique challenge if you're a builder or developer going out into the market and trying to raise funding. So we think we're going to play a strong part in that industry and helping them navigate the options available to them.
Well, it sounds great that you obviously got some practical experience on how things work. So in terms of your role then, so how do you, so if we're working with, say, a builder or a developer that is in a position where they need some funding, so how do you guys fit in, and sort of what is it you actually do?
Yeah, so I mean, we work directly with the builder or developer in terms of actually sourcing the funding. So looking at a feasibility or a project plan, and then actually looking at funding options and going direct to banks or non-bank lenders to find the best terms and pricing. And the thing about the industry now in New Zealand, we've actually got a growing non-bank lending sector, which is really quite diverse and interesting. We've also got private lenders coming into the market, as well as the banks. So there's quite a few options available to the industry. But if you're a small builder or a small developer, or even someone who's been an investor and wants to have a crack at development, the language of pulling together a lending proposal, how you structure a feasibility, these are typically pretty new things, new concepts to someone coming into the industry, and knowing what your options are. So we connect the industry. I think that the name Colab came out of the concept of collaboration, and we're very much collaborating with our lending partners as well as our clients to find the best solutions for everyone. And the great thing about the non-bank lending sector is there's so many more different options, a lot more flexibility, and makes it a lot easier for developers and builders. So
when you say non-bank, what sort of organisations are those? So obviously, most people are aware of what banks do. You go to them, get money, they charge you a whole lot for it. So what are the non-bank? Where do they fit in, and sort of how do they look? And like you're saying, it seems to be a relatively new thing, or the share of its market share in New Zealand's increasing. So it's a changing dynamic. So what? Yeah, tell us a bit about those.
Yeah. So I mean, there's probably a good sort of 10 different construction lenders in New Zealand who focus on that particular market, as well as a range of private lenders. And they all have their own kind of niche. So not every big non-bank lender is in the smaller end of the market. So some of them are more focused on the kind of 5 to 20 million plus kind of sector, while others are more focused on the smaller end of the market. You sort of 500K to kind of 5 million. So you need to kind of know which lender to go to, because obviously you want to get a customized solution, and you want that. You want the lender and the borrower to be on the same page, because obviously the lender's taking a risk with the developer or builder, and you want to have the project go as smoothly as possible. So we kind of navigate that together and try and smooth it out so that everyone's on the same page and the project goes to plan and it works out in the end. But it's a really fascinating space, and I love sort of going out there and finding creative ways of making deals work as well. Because sometimes you might have a deal that it looks like a bank might be able to fund it, but you bring in a non-bank lender, suddenly the leverage ratios goes up, or maybe the builder or developer is looking at another project and they need a non-bank lender to step in to help with a residual stock or a refinance to release some capital. So you're constantly kind of problem solving, and there's quite a creative element to it, in terms of structuring deals and making it work, and setting builders and developers up for success.
So is sort of a big part of the difference the appetite for risk? So I assume banks normally don't like much in the way of risk, whereas it sounds like the non-bank guys are a bit more open to things that maybe don't fit the rules that the banks work to?
Yeah, 100%. I mean, banks, retail trading banks in New Zealand are pretty risk averse. So if you look at the sort of typical leverage ratios on a construction and development deal, banks start to sort of run out of appetite at about a 50% LVR.
Whereas is pretty low, really. Yeah.
Well, it's very low. And I mean, if it's a pretty straightforward deal, it doesn't really provide the leverage. Real estate and property development, it's a leverage game, right? You need a lot of money to participate in it and get the return on equity that the developer or the builder is looking for. So leverage is absolutely key. And through the non-bank lenders, we can getting leverage ratios up to kind of an 80% LVR, and the loan to cost ratios as well can be as high as, say, 75%, whereas the banks, again, maxing out around that kind of 55% level.
When you say loan to cost, what does that mean?
Well, you've got sort of key metrics, loan to value. So if you're doing a project, LVR is the loan to the end value in terms of what you're actually going to get from a sale perspective at the end of the project. Loan to cost is, what is the loan value relative to the cost of the project. And so the difference between your kind of loan to cost and loan to value is typically your builders or developers' equity that's sitting in the project.
Right.
So you need to understand, these lending metrics and which lender is appropriate depending on the nature of the deal and making it work for everybody. There's also, quite different compliance requirements across the sector. So generally speaking, banks require a QS pretty much on every project over a certain value. And I think most banks, over $1 million, you pretty much need a QS, where a lot of non-bank lenders don't need a QS, and they don't need a QS involved in the drawdowns and and sort of overseeing the contract. Some non-bank lenders don't even need a valuation. They'll actually have the internal expertise to be able to look at a project and say, we can see that the value of this project is going to be X at the end because we understand the market. So, you're working with specialist lenders who really understand the market and the borrower's requirements, and that provides a much more customized solution.
And so I presume there's a premium in the interest rates between what a bank and a non-bank would charge?
Yeah, absolutely. So, I mean, typically non-bank lending rates are going to be at least kind of 3% higher than a standard bank. But, you get a lot more, I guess, leverage, which if you're looking at your return on equity in terms of the amount of cash that you're putting into a project, which is, really the key metric that any developer should be looking at, it can make a big difference on the outcomes and how you circulate your capital as well. So, if your money's all tied up in a project because you don't get the maximum leverage, then you can't move on to the next project. So it makes a lot of sense to kind of look at all options and, and weigh them all up.
Yeah, right. So these non-bank lenders, how do they differ from the old dodgy finance companies that were around sort of 2008 that went bust and took everybody's money? Is it the same people repackaged, or
no? They've evolved. They've evolved a lot. The non-bank lending market in New Zealand is very, very professional and run by very good operators. A lot of them have worked at banks. A lot of the key people in these organisations have come from property finance or corporate commercial banking backgrounds, so they understand compliance, risk management. The finance companies of the kind of 2000s that went down in the GFC, there were a lot of unprofessional activity going on with that group. A lot of conflicts of interest and related party lending. Most of the non-bank lenders have very good governance in place, and a lot of them are actually getting funded. So they'll have wholesale funding lines with banks.
Okay.
So. There's a level of kind of compliance and governance required around how they're operating their businesses, which come down from the banks that they're working with, and and I think the industry has well and truly matured and moved on from the days of the finance companies that went under in the 2000s.
So it's a way, in some cases, for the banks to basically expose themselves to that secondary market without being directly at risk in it, I guess.
Totally. So, a lot of the bigger finance companies, operating in the non-bank lending space, have facilities with banks, wholesale lending facilities. So they are effectively blending private capital with bank capital, and creating different construction and development finance products and solutions. And that ultimately brings down the overall cost, because if you're relying purely on I guess, private credit or private capital, it starts to potentially be a bit more expensive, but also just accessing bigger funding lines when you need to. Obviously, banks can efficiently, allocate and find capital a lot easier than a smaller organisation. So it's actually worked out really well and evolving, I think, quite nicely for the sector, and that the stakeholders are working together in a way which is quite sort of symbiotic.
So could a developer or a builder go and talk to these organisations directly themselves, or do they have to use a mortgage broker, or is it better to use a mortgage broker? Or
yeah, look, some of them certainly have their own sort of BDMs and lending managers who work directly with borrowers, and that might work if you're a really experienced developer and maybe you've got a really good relationship with a given lender, and you've managed to kind of secure terms that are really suitable for yourself. But I would say the market is moving really quickly at the moment. There's with an expectation of an uplift in property values, and coming out of this sort of property slump that we've had, I think 2025 is going to be a lot more positive. So going through an advisor or a broker like Colab, we know what's going on in the market. We can see where the liquidity is. We can see where the lenders have appetite and match them up. And we're actually working with some of our lending partners on some bespoke solutions, targeting specific niches where we know that there might be a underserved market segment, and we think that there's a real opportunity for a lender to step in and say, actually, let's look after this particular borrower group, because the risk profile is a lot more sort of manageable, or maybe they've just been generally underserved by the market over the years. So so there's a lot of value in going through a broker and getting access to the entire market, rather than just relying on the one provider.
Yeah, and I guess you're looking to try and play, I guess, both parties. You're trying to provide a service to the people looking for the money, and then you're trying to provide a service to the people with the money to get access to it. And I guess you're across multiple ones at both sides, whereas if it's a one-to-one thing, you get whatever that lender wants to talk to you about. You don't get exposed to the other options, I guess.
Yeah, exactly. We get to look at the entire market and create some competitive tension and make sure that the risk reward is I guess appropriate for the borrower and for the lender. And sometimes we're sort of brought in to be a little bit more creative in terms of the capital stack, because you might have a layer of equity, there might be a first mortgage. Sometimes we might need to go out there and find a second mortgage or a mezzanine layer to make the project work. So working with
and each of those having a different interest cost to them, I guess.
That's right, yeah. So you kind of come down the capital stack, and there's different levels of security and naturally different rates of return. And so part of our role is to bring the projects together. And if it's a really strong project, you can kind of get the leverage ratios right up there, because you might be able to have a first mortgage at, say, 65%, and maybe a second mortgage or a mezzanine that takes it up to 80, 90%, depending on if the project's got pre-sales or not. So understanding where the different sort of investors sit in the market and lenders, and being able to bring the deals together and make it work. It's a really kind of satisfying part of the role, because you're very much in the middle of making the transaction work, and it's quite satisfying.
It sounds quite dynamic, and there's lots of levers you can pull to be able to make things work. So.
Yeah, lots of levers, and it's an ongoing thing. Like you get a developer, they might finish a project, or they're trying to sell a project. Maybe they need a refinance, or they need some type of exit strategy out of the construction loan. Because bear in mind, construction lending is typically short term.
Yeah, I was going to ask that. I get the impression that the non-bank lenders are generally, you're not talking about taking a 30-year mortgage out with them.
Exactly. Yeah. So I mean, we're not we're looking at kind of 12 to 24 months for a typical construction loan, and we're not looking. Non-bank lenders doing construction lending aren't looking at the borrower's capacity to pay the loan off in that given period, whereas obviously a standard residential mortgage or a commercial loan for a commercial property, you're looking at the capacity for the borrower to actually service the mortgage and pay it off over the term of the loan. So it's effectively asset-backed lending. But again, we're quite keen in terms of showing and demonstrating, that the sponsor and the developer's got the capacity to actually deliver on the project in that given time frame.
Yeah.
And then bringing other professionals into it as well. Like, when we do need a QS, for example, we have contacts in the sector and we can bring those specialists in to help bring the project together.
So it's almost about the exit strategy from the assets more important than their ability to pay for it, so that
Very much so.
they've got a view of how they're going to get to the end and then get out of it and be able to pay back the money by doing that.
Exactly.
Get a profit.
Yeah, exit strategies are key, and the challenge that we've had over the last couple of years is that it's been almost impossible to get pre-sales, so that pre-sales, off-plan pre-sales unlocked the potential of a project. So if you had a development in mind and you could pre-sale a percentage of the project, then the lenders would be a lot more confident and comfortable taking the leverage ratios up, and maximizing that. Whereas, most, there haven't been many pre-sales because we've had a slower market, and purchasers, buyers have been reluctant to buy off plan. So in that regard, it's been a really challenging time.
Have you seen much of a backlash of people were getting the pre-sales, and when it was going crazy, people were signing up on a pre-sales thinking they had a locked-in deal, and then 2 years later, the developer would realise they could sell it for a whole lot more and find some out clause and leave the person out of the market for 2 years thinking they had a deal and they didn't. And I just wonder, have a lot of developers burnt off the ability to have pre-sales because of that bad track record?
Yeah, look, no developers that I personally know of. I mean, it's it's certainly happened. I mean, sunset clauses and contracts should be reviewed by a purchaser solicitor and make sure that they've got protections in place. But
I guess nobody ever expected it to be quite so dynamic, and the other way around, that normally the sunset clauses was thought of being there to allow the buyer a way of getting out if it turned to custard, not the developer.
Not the other way around, exactly. So no, it's something that everyone needs to be aware of. But I haven't seen many reputable developers, kind of use those sorts of tactics. And obviously, prices have been going down. So anyone who's been buying off plan over the last couple of years, hasn't really, there hasn't been an incentive for a developer to kind of pull those sort of tactics. But look, it's always something that anyone needs to look at in a sale and purchase agreement and make sure they've got protections in place.
So how possible is it for a developer? Because pre-sales have really been a part of the mix for a long time now. We've not really had the sort of market we're in now for 10 or 20 years. So how are they making it work if they're saying there's basically zero pre-sales? How do they make it stack up?
Well, there are still pre-sales occurring in some parts of the market. There's a sort of residential investment side of the market which has sort of been ticking along. You've got some developers that are literally just spec building and looking at the potential upswing in the market going into next year. And so there's still activity, but it's been a quieter market, obviously, without the pre-sales across the industry, and a lot of the bigger projects have been stalled. Yeah. There's a lot of land subdivisions, a lot of sites that are still sitting on the market. But I think getting interest rates lower, getting confidence back into the market, purchases come back. It's the whole thing. It's very interconnected. Getting the purchases back into the market will be key in terms of opening up the development side of the industry.
Yeah, we've seen it in our business. So we didn't really do much in the way of development stuff last year, but we've seen a bit waking up now. And then some projects we worked on a couple of years ago, the developers coming back and saying, "Oh, can you update the pricing?" So I'm sort of getting the impression that the cogs are starting to turn a bit, that they're starting to think. And I guess they're looking, 2 years, 3 years out, because there's such a long lead time from when they push the go button to things actually being ready for sale. So they've got to be trying to, I guess, second guess the market so that they're not behind.
Yeah, exactly. And I think probably seeing more joint ventures in the market where you've got a developer and maybe a high net worth investor who's putting in a layer of sort of equity or preferred equity, or maybe it's an outright joint venture. So the combination of those two kind of capital stacks, capital sources going into the development, where, once pre-sales come back, developers are going to be in a stronger position to be able to negotiate terms with the lender and get the maximum leverage ratios without relying on another equity or mezzanine investor.
Because I guess the most expensive form of capital is a partner.
Exactly.
You're giving them half the return or whatever. Yeah.
Exactly. But if it means a difference between making a deal work or not, and I guess you've got builders and smaller developers that are just keeping things moving, even if they're doing it at a much lower margin. And that's certainly what I've seen over the last couple of years, is that the development margins have come right back. And so, what developers have been willing to do to kind of keep projects going in terms of the returns have been a lot lower. So we'll see those come back and hopefully increase in the next year.
Do you get any sort of feel as to where the price points are? So where most of the market, I guess, has been over the last couple of years, and where you think it's going to go in the next couple of years? Do you have any feel for that?
Yeah, I mean, interest rates in the non-bank lending market typically track the sort of OCR or the sort of wholesale BKBM rates, which are the kind of short-term money
BKBM?
Bank bill rates in New Zealand. They're sort of like a measure of the short-term money markets out sort of 3 months. So BKBM is a sort of benchmark rate that the banks use to price interest rates off. And, obviously that's typically set off the OCR, or the official cash rate. Yeah. As the cash rate comes down, again, a lot of non-bank lending is on floating rates because it's short term. Yeah. And as the OCR continues to come off, obviously we've had a number of cuts this year. We're expecting further cuts next year. The Reserve Bank has already said that the neutral cash rate is around 3%, and we're still over 4% or so at the moment. So, we'll get another 1% off the effective rates. But we're seeing lending rates, around sort of 9-10% at the moment in the non-bank space. There are establishment fees as well. So establishment fees can be another 2%. Sometimes line fees, but again, it just depends on the project, depends on the sponsor, depends on obviously where the cost of funds are in the interest rate market at the time. But there's a lot of liquidity out there. There's a lot of appetite to make deals work. And the confidence is starting to come back. So
sort of touch on a bit. So where do you guys make your money? Who pays you?
So if we're doing a transaction directly with a client, we charge an upfront brokerage fee, which is part of the establishment fee cost, which is built into the transaction. So, for example, we might charge anything from 0.5 to 1% on the loan value that we arrange, and that gets built into the loan limit and paid to us at settlement. So, builder developer doesn't need to pay us that up front. It gets funded and capitalised into the loan. So that's pretty much how most of the industry gets paid. Yeah.
And so you effectively is built in as part of that, and you're paid by the bank or by the builder?
Well, the funding is actually so the funds are drawn down on the initial advance from the non-bank lender. Our fee, the brokerage fee, is just part of that. Is part of that, and it's the client is paying us, because it's being, it's coming out of their limit, their loan limit, but it's being funded by the lender typically. Yeah, right. And I mean, the other thing with those types of having more flexible loan terms is the ability to capitalise interest and fees. So any fees associated with arranging that type of funding, you can capitalise the cost of the establishment fees and the cost of the interest, because most developers don't want to be servicing interest through the life of the loan. If they're focusing their energy on getting the project done, they don't want that loan servicing cost. So most of the time we're also capitalising the interest into the loan facility. Yeah, right. Which then gives them incentive to get it done as quick as they can as well, because stop that building up too much. Exactly. Yep. It's interest on interest after if it keeps rolling is expensive. And some of these ones I've seen, like there's one down in Onehunga Mall, I think it was 130 units, and they're still sitting on like 30 to be sold. So how much pressure's around with some of those ones where they've struggled to move the thing through, and sort of how does that fit with the sort of financing models that probably would have put in place when they first kicked them off? So in that situation, we call that a residual stock lending. So once the construction loan and the project has been completed, the the stock itself can be refinanced. So the completed units, the completed apartments can be refinanced to another lender. Obviously, that lender will have their own lending ratios, but they'll be a little bit different. Pricing will be different. The LVR levels might be a bit different to a construction lender.
Right.
So construction lending and the sort of value add kind of component of, taking a bit of dirt and turning it into apartments or townhouses or standalone houses, it's a different type of loan structure. Whereas the refinance of the completed units usually sits with another lender or a different product within that lender's appetite. Yeah. So there's ways to make the deals work if the developer doesn't want to sell the stock at the end. So we've seen a lot of residual stock lending over the last 12 months because the project gets complete. Maybe they've got a few pre-sales from a year or so ago. Yeah. Maybe they've rented a few of them out and decided to hold on to them. So you've seen a few developers kind of pivot into a sort of build-to-rent kind of model where they're actually sitting on them and want to try and ride it out to get an uplift in the market.
So get a bit. Hopefully, I guess they were hoping to get a better price than what they would if they sold them at a fire sale at the end or whatever.
Exactly. I mean, it's still a risky game because you typically, you're getting another, cost of funds for that period of time that you're refinancing it, and you're hoping that the market's going to recover. But we have seen a lot of that over the last 12 months, and I guess the market has been reasonably resilient through what has been a sustained kind of downturn. And you think about the interest rate cycle that we've had from the post-COVID stimulus period through to today. It's been a pretty wild ride, and the fact that we haven't seen more builders and developers go under, I think, sort of demonstrates that the industry has matured and there's more resilience perhaps than we would have seen 20 years ago.
So we've seen the government talk a lot about competition, and it's been in the banking industry, and it's been sort of quite a bit in the media. Do you think it's going to change? What are you aware of in sort of in terms of initiatives that you're talking about, and do you think any of them are going to work? Do you think it's going to change the dynamic? Yeah, it sounds like your sector's pretty competitive anyway. It does sound like
I don't think the attention of the Commerce Commission really is focused on kind of construction lending as a general sort of observation. I think it's good to see the Commerce Commission giving the banks a nudge, particularly around open banking and starting to open things up to make it easier for people to switch banks, provide more kind of technology solutions. But I think it's more focused on the residential end of the market. The consumer side of the market. I think there is still, an argument that banks in New Zealand are still too conservative around business lending, and we talk about, the lack of sort of funding that some small businesses, aren't getting enough funding in New Zealand. But I think, open banking and some of the push from the Commerce Commission should push them along a little bit.
Yeah. Oh, that's good.
Yeah.
Oh, well, thanks for your time today, Dan. Is there anything else you'd want to raise on this? Any burning issues on your chest that you want to get off?
No, not really, mate. I think as I said, it's been a pretty interesting few years, and looking forward to an uplift in the market as everyone is. I think it's been quite a challenging period for a lot of industry stakeholders, and I think everyone's looking forward to a more normal market, and hopefully we can crack on and get some deals done.
And if people wanted to talk to you, what's the best way of getting in touch with you?
So I'm on LinkedIn, so just Dan Bell on LinkedIn. Our website is colab.kiwi, and my email address is dan@colab.kiwi. So you can find me on those channels.
Hey, well, thanks, Dan. Thanks for your time today. So I'm Nick Clements from YourQS. If you want to talk to a QS that really knows what he's talking about and has lots of good contacts like this, then get in touch with us.